Good morning, everybody. Welcome back to the Opportunistic Trader. I just wanted to point out that we just had Michigan confidence come out. A very high number, came in at 100.8. Expectation was 96.6. That said, pretty muted reaction across fixed income. So we'll keep a close eye on that. The 10-year traded just above 3%. We're just a touch below now. We're at 299, so we're right there. And S&P right now is flat on the day, so we've come off a few points. The high was 29.12, right now 29.05. But we're joined by Tony Greer of TG Macro. He was with us yesterday, and Tony, welcome.
How you doing, Mike?
Great. It's Friday, so that's a good thing. And so what are you looking at right now? So the yields are obviously key. We got some good data. What are your thoughts?
I kind of disagree with you that there's a muted reaction in the bond market this morning. I think there is a significant reaction in the bond market this morning. You know, this is what we were talking about, where if you were sitting here waiting for the economy to roll over, you're holding the chart upside down. You know what I mean? We just had good numbers again this morning. The retail data was mixed, but we beat industrial production again. Like you pointed out, sentiment is flying. And so bonds making a new low is relevant because the market is insanely short treasuries and they've got it right now. So that is not one of the positions on the board that I want to draw a bullseye on.
Yeah, no, I was only pointing out that basically in the past 2 hours, obviously the 10-year is down 8 ticks, the bond is down 23, but basically on the data over the last half hour, we haven't really moved a whole lot over the past 2 hours. And like you said, the retail sales was a bit weaker, but the revisions were actually better. So I think they're looking at that as well.
Yep. Well, it looks like we took, there's a little bit of more pressure off of the emerging markets this morning. There's another little bit of a bounce in some of those currencies. So that's taken, the pressure off of the European banks, and sort of, we just got a big rotation now. This looks like there's a little bit of a bounce going on in semis. The transports, we've been seeing, pretty strong action in transports with trains and trucks. And so that index is trying to carve a new high. That sector is trying to carve a new high, which is relevant. The social media sector is bouncing, right into our trap. I'm hoping that we see that thing north of 33, 34, so we can lay a short out again. I'm pretty pessimistic Twitter and Facebook still. Neither of them have significantly bounced. They're both kind of dragging on the lows, and I expect that to continue. And I'm looking for some other opportunities out there. I'm not sure what else I'm going to get into for the rest of the year. I'm looking at the chemical companies. They've started curling over. And I have to do a lot more homework to see what's driving it. But, whenever there's any weakness in, Westlake Chemical, and there's a couple of other, let's see, what was the other name I was looking at yesterday? Chemical space. Sorry, what chart was it? Oh, Eastman. Westlake and Eastman Chemical, to me, are two charts that are sort of curling over through their moving averages and have a chance to pull back significantly. So I'm watching that for my next move. But other than that, man, I'm looking to coast into the finish line today.
Yeah. What about the dollar? It's pretty interesting. Yields have been moving up, like you said. The dollar is actually weaker on the week, but it's more of like a G10s versus emerging markets. But what do you take of dollar yen here at 112, euro 116.70, yields at 3% in the U.S.
Yeah, I'm still friendly to the dollar. Nothing is going to change there. The dollar index just tapped the 100-day moving average support. It bounced fairly nicely off of that. Dollar yen is, like you just said, is sort of climbing to the top of the range. Well, it's actually sort of the middle of what I'm calling the range here, being 110, 114. So we're right now at 112, sort of the middle of the range. And I think that can creep higher, although volatility has really been sucked out of dollar yen with the BOJ nailing their yields, keeping their yields pegged. So that has been, it hasn't been an exciting trade. But that's the whole thing to me, is that I think the dollar is going to stay strong. It's going to be more at the expense of the EM currencies rather than the majors. And that's what we're seeing. That's sort of paving the way for a strong stock market, a weaker bond market, higher yields in the U.S., and, sort of going on our merry way with this rally in equities.
Yeah, it's interesting. The S&P sold off a little bit from the high. We're off about 10 points from the high, and financials are trading well, and I think that's part of what you're saying as well with the yield story and emerging markets. A little bit of relief on the financial sector, whereas some other sectors are starting to, rotate a little bit. And as you've been pointing out for a number of days, your social media is definitely not performing that well.
Right. Exactly. So I think there's a good chance that they close this week really, really poorly. I'm looking for an acceleration lower in Twitter and Facebook still. That social media ETF, I think it's still rallying because IAC Interactive has not found a ceiling. The stock has gone from 200 last week to 223 today. So we've got about a 10 to 12% increase on the week. It's really getting stretched away from its moving averages now and is literally just taking off. So this is the kind of thing where, the parabolic rally gets a little bit silly and you expect that to pull back. And I think once IAC finds a level that the social media ETF will resume its path down.
Yeah, and I just pulled up a chart of BABA. We were talking about that a little bit earlier in the week or last week, and it had a little bit of a relief rally, but it's off today. That's been underperforming heavily, especially versus the U.S. Tech names and social media names, things like that.
Yeah, BABA traded right up to the neckline that it broke down from and failed, and now it's heading the other way today. I mean, that whole thing with Jack Ma resigning, and we're seeing a little bit weaker data out of China. I don't know, maybe it makes sense to just be out of those names for now.
Yeah. What sort of technical indicators are you looking at most often when you're looking at, especially whether it be the social media stocks or when you have kind of a view on a trade? What sort of moving averages do you look at to try to confirm that?
I try to keep it really simple, Mike. I use the 50, 100, and 200 days moving averages really exclusively. I like to see when they curl up or down through each other because that usually means an acceleration is coming or in the middle of happening. And I'm a big trend line guy. I keep it really basic, really simple. I've noticed that, CTAs tend to add to positions through trend lines, get out of positions through trend lines. And so if, you start spending some time on the charts, drawing all those trend lines up, you can probably find some pretty good spots where some securities are going to accelerate. So that's my basic bread and butter right there.
Yeah. What about with this storm coming on the east? Are there any trades you're looking at that might be big movers on Monday based on if the storm is not as bad as expected or is worse than expected?
Yeah, that's a good question. I mean, as you know, I've been a crude oil bull and I remain bullish. I want to see how it comes out of the hurricane. I mean, this is really probably one of the most important factors to it, to the strength. We saw a little bit of a pullback 2 weeks ago to the 200-day moving average at 65.5, right? We got the rally back up to 70, but we left a little bit of a double top at 70 on the chart. So I'm assuming that we're going to kind of back and fill between 65 and 70 now. I will definitely be concerned if we come out of this hurricane next week and oil starts trading down below the 200-day moving average. That'll mean that there's a little bit further of a pullback. But I'm still looking to buy energy stocks on the dip. I don't think that there's any danger in doing that. I'm still expecting energy stocks to, at some point, really catch a leg up here and break through, for the XLE to break up through 80.
When you were saying the 200-day moving average, what are you looking at? Futures or XLE or?
Well, 200-day, I was looking at XLE then and crude oil there, which they both, kind of dipped to the 200-day.
So where is the 200-day on XLE? I just brought up the chart.
72.92.
72.92. Okay.
Yeah.
That's a pretty interesting level. Like, we've actually been talking about a fair amount. Crude's been very volatile. That said, we're in a range. It's been short-term volatile, but in, a 12 to 15% range for the past number of months. We're getting these 3, 5, 7% moves within this 10% range.
True. Yeah, Brent took off right to the highs again.
Yeah.
That had to do with, Iraqis threatening production, threatening closing down the Strait of Hormuz. So Brent went right back to $80. The Brent WTI spread has been really, really firm since, it broke back away from, the support level it pulled back to around $4. It basically doubled pretty quickly from 4 to 8, traded as wide as 10. And since that was a driving force to the whole crude oil rally, that is why I'm expecting crude oil, WTI, to be a little bit higher and the whole complex to be a little bit higher. Given that it's not, I'm really cautious that it could pull back. So, that's really it. It's just regular trader, trader mentality of being, cautious about your positions and knowing what's out there that could bite you in the ass.
Yeah, absolutely. So yeah, XLE, will keep an eye on that for that 200-day. Um, I was going to ask you something else about crude here. We've been keeping a close eye with the storm. Um, are there any names specific within the energy sector that you like more than the others?
Yeah, I like ConocoPhillips a lot because that chart to me has just been a really, really steady climber. It behaves well against the moving averages. I mean, this has been a beautiful trend from 45 right up to 75. And as long as that thing remains in trend, I want to be long it. I also like Oxy in the space. Oxy, I think, has given you some really good opportunity to buy again at the 200-day moving average. The company's in great shape. They're well positioned in the U.S. And I think that this dip is perfect for me to be buying, and with a great risk reward, you can stop out below the recent low. Yesterday was great price action in Oxy. It opened up below the 200-day moving average. It carved a new low for the move down to 75 and bounced $2. So, I'm looking for that to sort of get washed out on the downside at this level, pick some up, and then watch it break through the moving averages up at 81 again, and then it'll get on its run. So Conoco and Oxy, man, those are my two favorite picks. And as you know, I'm a big, even bigger pick is my pick in the refiner space, which has been Marathon for pretty much the whole year this year. Marathon Petroleum has hung in better than the others. I saw that Berkshire Hathaway cut their stake in Phillips 66, which I think put a little bit of a cap on that rally between 110 and 120. Delic was another name that was running up ahead of all the other names, and that's had just recently pulled back, ticker DK, from 55 to 46. And that's kind of telling me that I'm in the right name here in Marathon Petroleum because it keeps bumping its head up against 85, but the pullbacks have been shallower, more and more shallow. So I'm getting confident that Marathon's going to break through that 85 high and keep going. So those are my three names: Conoco, Marathon, and Oxy.
Interesting. Yeah, we'll definitely keep an eye on that. And then, just skipping back to yields, if we were to get a continued move higher in U.S. yields, is there a specific sector that you like based on that should outperform?
No, like I think you asked me that. My point is that I feel like the equity market is totally, it's dealing with higher rates. It's not derailing the rally at all, as you can see. And so I kind of picture the market grinding higher in maybe, grinding slowly higher in a sort of sideways to higher fashion as we sort of rotate aggressively. And as you know, the rotation that I'm kind of expecting is the rotation out of big tech, out of social media, maybe obviously out of any metals and mining names, and a rotation that's going to go sort of into transports, into energy stocks, into some of the other names that have been, sorry about that, I just got a message here I had to read, into, and healthcare stocks, which just seem to, break out to new highs. So, with that said, I see S&P sort of sideways to higher at a slower ascending pace. And that's the kind of rotation I'm looking for, the one that I just illustrated with a close eye on crude oil.
Yeah, no, that's really good. Really laying it out there. More, taking a pause in tech and metals. Well, you've also been bearish metals for a while, which has done really well. And
bearish precious metal, bearish gold and silver metals and mining specifically. And GDX has been hammered, right down to the low of 17. It bounced $1. All the bulls got really excited. They had a group hug, and I think it's going to take its way back down.
From talking with a lot of different friends and people in the industry, I get the sense a lot of people have underperformed this market this year. So far Nasdaq has outperformed, and there have been, S&P's up 8 or so percent, Nasdaq's up like 15%, and a lot of people are trailing that. Where do you get a sense a lot of people have been positioned that has led to that underperformance so far year to date?
Probably cautiously and on the sidelines. Right. They probably are underperforming because they're missing the rally. They're probably missing the rally because they're looking over at Europe and they're seeing a really toxic situation with, currencies combusting and European banks combusting alongside them because they're long the debt from those countries. So when you see things like that, it sort of makes the sensible man say, you know what, I'd rather not have that much risk piled into this market. especially when it's really been tech leadership the whole way. And now we've got a reason to sort of be skeptical about tech outside of Apple and Amazon. So given that's the case, it's really not shocking to me when you've got some scary macro situations as an overlay to a market that just refuses to go down. It feels like the path of least resistance is still up for the S&P. And I'm hesitant to fade that, as much as I believe that we're in a higher vol regime and that the S&P goes up slower and with more significant pullbacks along the way. We have not even come close to derailing the bull, even with this huge emerging markets blow up.
Yeah. Last question for you before I let you run. So this weekend coming up, what do you read on a weekend to get you ready for the next week and, things like that? What are you reading over the weekend?
Yeah, the most important thing I go over, really, to be honest with you, it's more, reading the markets is what's important. The Friday closes are sort of sacred for me, and this is a sort of middle of the month close. So I have a report associated with the middle of the month. And, I see I take a look back and I see what the leading sectors for the week were, what the losing sectors for the week were, what the biggest names that drove those sectors either up or down were. And I sort of put those on my radar for the next week, right? Because if we're looking for trends, we're expecting the same things to happen repeatedly. And that's really where I do the bulk of my work over the weekend. I try to read things over the weekend that are sort of highly non-correlated to the markets. I read for pleasure on the weekends, Mike, because my eyes get cross-eyed from reading, digits and data all week. So on the weekends, I do pleasure reading and I look at the charts and decide where I want to focus next week.
Okay. Yeah, good stuff. And, you can take a look. Tony's got a great letter, TG Macro. Take a look at his website, and you can see he has, like he said, whether it be mid-month, he really looks at things a little differently, a bit more macro, and he's got some great information in there. So take a look at that. Tony, thanks a lot for joining us, and, have a good weekend.
Cool, man. You too, Mike. Thank you.
All right. We'll talk to you soon.
Yep. Take care.